In today's episode, I'll talk about two interesting stories. In the first one, I'll talk about where China really stands in the global chip race and what their struggle to catch up really tells us about the future of technology. And in the second story of the day, I'll talk about why foreign investment into India is slowing down and what it'll take to turn that around for us. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 18th of June. Last week, something very interesting happened. The founder of Huawei, which is one of China's biggest technology companies, made a statement that caught many people off guard. Rang Zhangfei essentially said that the United States was giving Huawei too much credit and that his company was not as advanced as American officials seem to think. He said, and I quote, "The US has made exaggerations about Huawei's achievements and Huawei is not that good yet." Now, interestingly, around the same time, Jensen Huang, who runs NVIDIA, offered his own take on this. See, while he agreed that China was not quite at the technological frontier, he added something very intriguing. He said, and I quote, "If the United States does not want to participate in China, Huawei has got China covered. Huawei also has got everybody else covered." Now, the thing is, these comments have opened up a very fascinating question which goes far beyond corporate posturing. Where does China really stand in the global semiconductor race? How close are they actually to catching up with the West? And what does their journey really tell us about the future of technology and geopolitics? That's exactly what I'll talk about in this story today. And to understand this a little bit deeply, let's very quickly go back to what semiconductors actually are and why they matter so much in the first place. See, very quickly, you can think about semiconductors as the very tiny brains that are inside every electronic device that you use. Your phone, your laptop, your car's navigation system, etc. All of them essentially run on these very chips. Basically, the more advanced the chip, the more powerful and efficient your device eventually becomes. And here is the crucial part. Making these chips is one of the most complicated manufacturing processes that humans have ever attempted. I'm talking about carving patterns onto silicon wafers that are measured in billions of a meter. Now, for many decades, this particular industry operated like a global orchestra, if I could put it that way. American companies designed the chips, Dutch companies made the machines to manufacture them, Taiwan and South Korea actually produced them, China assembled the final products, and everyone essentially played their part and the system worked beautifully together. But only until it actually did not. The United States actually grew worried that China was getting too good at making advanced chips, especially the ones that could be used for military purposes or artificial intelligence. So they did something very dramatic. They completely banned China from buying the most advanced chips and the equipment that is required to make them. Taiwan also joined into this, the Netherlands also followed suit, and all of a sudden, China found itself cut off from the bleeding edge of semiconductor technology. And that is where China's story gets a little more interesting. See, in most situations, the best strategy is what experts call an emergent one. This is essentially things which you stumble onto through trial and error rather than actually plan perfectly from the beginning. Now, the thing about crisis is that they have a bad habit of throwing your best plans into the ocean, and China knows this better than most other people. So rather than giving up, they decided to improvise their way forward. Their first move was to lean heavily on what they already had, which was an industry making older and less advanced chips. Now, mind you, these legacy chips, which are typically 28 nanometers or larger, might not really power the latest AI models, but they are perfectly fine for countless everyday applications. You can think about things like washing machine, basic smartphones, car components, etc. China had been building this very capacity since the 1990s through state-backed projects like Project 808 and Project 909. And while these efforts have not always found commercial success, they provided a foundation for them to build upon. Then came China's next move, which was particularly clever. See, they embraced something called open source instruction set architectures. Now, I know that sounds a little bit technical, but trust me, it's very simple. See, every chip needs a set of rules which tells it how to communicate with a piece of software. This is very similar to a language that lets hardware and software understand each other. Now, the two dominant languages, ARM and x86, are privately owned. And if you want to use them, you need permission and you also need to pay. But there is a third option called RISC-V that is completely open and free for anybody to use. Now, while RISC-V is not quite as powerful and and efficient as ARM yet, China saw an opportunity there. They poured money and engineering talent into improving it in the first place. Major Chinese companies like Alibaba, Huawei, and Tencent joined the RISC-V board. The government announced plans for a nationwide push to encourage for its use. It's almost like creating your own language when others will not teach you theirs. Now, Chinese companies also got very creative with packaging here. Instead of making one super advanced chip, they figured out how to combine multiple less advanced chips in very clever ways. For instance, Huawei's latest AI processor, which is the Ascend 910D, essentially bundles four older Ascend 910B chips all together. It's not quite obviously as elegant as having one single cutting edge chip, but of course it gets the job done and it's like a great jugaad. Anyway, the thing is, the semiconductor supply chain involves much more than just manufacturing chips. You need to design them first, which by the way is incredibly complex because I'm talking about arranging components at the atomic level. Most companies today are fabless, which means that they design chips in-house but they outsource manufacturing. Chinese firms have gotten surprisingly good at this design work. By 2020, they held about 16% of the global fabless market, behind only the United States and Taiwan. Huawei's chip design subsidiary, which is High Silicon, became particularly capable at designing processors for Huawei's phones. Then there is the actual manufacturing or fabrication process. See, setting up a chip factory costs hundreds of millions of dollars, but China has been on a construction spree ever since then. Since 2014, they have announced over 110 new factory projects worth 196 billion US dollars. Now, 40 of these are already running and about 38 of them are still under construction. But anyway, back to the process. After the chips are made, they need to be assembled and tested. Now, this is the least technologically demanding part of the entire process, and Chinese companies have excelled here as well. Now, several companies, including the JCET Group and Tongfu Microelectronics, rank among the global top 10 here. In memory chips, which is by the way the kind that store your data in your devices, a partially state-owned company called YMTC went from being a startup in 2016 to now producing the world's first 200 plus layer 3D NAND flash memory and capturing 5% of the global market by 2021, and they're expected to reach 10% by 2027. Now, all of this is actually guided by what China calls the Big Fund, which is a state-backed investment vehicle that has raised over 50 billion US dollars since 2014, with plans for even more. Now, the goal is very ambitious here: achieve 70% self-sufficiency in chip making by this very year. But here is also where reality sets in. See, despite all of these efforts, China remains significantly behind the technological frontier. The most advanced chips today are made with something called extreme ultraviolet lithography, or EUVL. For simplicity's sake, imagine focusing a light with such amount of precision that you can carve patterns which are smaller than viruses onto silicon. And this requires a laser-produced plasma approach, which is extraordinarily difficult to master. Only one company in the world, which is ASML from the Netherlands, has perfected this technology, and due to US pressure, they are also banned from selling it to China. Now, Chinese companies like Huawei and SMIC are trying to develop their own approach using something called lithography directed plasma, or LDP. Now, while the full technical details are not known to any of us, what we do know is that it is far from ready right now. ASML's dominance took years of development, massive capital, and lots of trial and error. China expects to roll out LDP technology by next year, but it is very unclear if it will match ASML's capabilities. And the thing is, even if it does work out technically, turning it into a commercially viable product will be a very big task. So for now, China is stuck using older deep ultraviolet lithography, or DUVL technology, and this is simultaneously more costly as well as less efficient. Its yields are also lower, which means far more chips made with this technology turn out to be defective, but that's pretty much what they have. Using DUVL, SMIC became the first Chinese firm to successfully mass produce 7 nanometer chips in 2022 and is reportedly on track to develop 5 nanometer chips this very year. And if you take a look at the numbers here, they also tell a very stark story. Taiwan's TSMC is already mass producing 3 nanometer, 2 nanometer, and even 1.6 nanometer chips, which is the most cost competitive in the entire world. And meanwhile, SMIC's 5 nanometer and 7 nanometer chips will be 50% more expensive than TSMC's offerings. And to be very honest, SMIC's yield rate of around 40% for its 7 nanometer chips is completely pale in comparison to TSMC's 80%. And that also means that SMIC wastes 3 times as many chips in the production production process. And that very gap also becomes very glaringly obvious with AI chips. See, Huawei leads China's efforts here with its Ascend 910B, but it trails NVIDIA's H100 and B200 chips considerably in inference performance. The Ascend 910C, which combines two 910Bs, achieves only 60 to 70% of the H100's performance. Now, this is partly a structural barrier because Huawei builds its chips on SMIC's relatively inefficient 7nm node, while NVIDIA actually works with TSMC's cutting-edge processes. Now, the question is, could Huawei possibly match NVIDIA with its current capabilities? Perhaps by building huge clusters of chips that collectively do more. Their Cloud Matrix CM384 cluster, which uses Ascend 910C chips, actually has higher memory bandwidth and compute power than NVIDIA's GB200 NVL72. But that said, there is a massive catch here. This consumes more than 4 times the power. The software ecosystem presents one more major hurdle here. Huawei's software platform, which is called CANN, has some serious problems. Developers report bugs that make the Ascend chips almost unusable to many people. Major customers like Baidu and Tencent complain about frequent crashes as well. And meanwhile, NVIDIA's CUDA ecosystem, which is one of the company's strongest advantages with huge global developer communities, is constantly improving on this. And that very thing creates very powerful network effects which reinforce NVIDIA's dominance. Now, the truth is, no matter what the headlines say, the West currently remains far ahead of China in the chips race. And this becomes crystal clear when you compare total compute capacity. It is very difficult to beat a combination of economies of scale and network effects when you are starting from behind. But even if you keep that aside, there is still one more deeper problem. So you might wonder why we keep hearing about groundbreaking chip innovations from China that never seem to make it to the market. Now, the answer actually lies in the difference between making something work in a lab and actually mass producing it profitably. China has now run into this very commercialization wall repeatedly. Much of China's chip industry is actually driven by state-owned enterprises. SMIC, for instance, is roughly 50% state-owned. And these companies survive largely on government contracts and military applications rather than competing in the open market fairly. And while a private firm like Huawei has succeeded in creating globally competitive products, it is the exception here and not really the norm. And this creates a fundamental contradiction. China sees its public sector enterprises as key to achieving chip autonomy, but without the harsh testing ground of consumer markets, such autonomy may not really be sustainable. And the big fund's operations have been far away from being smooth. Top officials have also been investigated for embezzlement. Tsinghua Unigroup, which was once a star state-owned player, had to restructure under bankruptcy laws in 2022 with its former CEO sentenced to death as well. HSMC, which is a flagship project of the Wuhan provincial government, collapsed in a multi-billion-dollar corruption scandal. And corruption is not the only problem, mind you. The big fund's loose and wide investing strategy has led to countless failures. Multiple foundry projects have shut down after burning through government grants. Basically, China has built the world's most expensive silicon carbide fab, but industry analysts cannot really justify its cost as compared to Western facility. And the result is a graveyard of failed projects. To give you a sense, while 52,000 new chip firms were registered in 2024, more than 14,000 shut down in the very same year. And this truth has scared away private investors, especially foreign ones. And these failures, by the way, even show up in real-world dependencies. Even DeepSeek, which is China's biggest AI model, continues to train on NVIDIA's chips. And Huawei's Kunpeng 920 CPUs still rely on ARM architecture. Basically, the dream of self-sufficiency for them remains frustratingly out of reach. But that said, it would still be very foolish for anybody of us to write China off. They hold a very powerful trump card. China is the world's largest semiconductor market, accounting for 31% of all global chip sales in 2022. They are also responsible for 16% of global chip production, which was up from 7% in just 2020. Now, that sheer scale makes them impossible to ignore here. And more importantly, China leads in industries that consume massive amount of chips. From smartphones to drones, from electric vehicles to humanoid robots, Chinese companies actually dominate all of these markets globally. And that creates countless opportunities to test, iterate, and improve their chips in real-world applications. Some Chinese companies have leveraged this to build impressive, vertically integrated operations where they control everything right from chip design to final products. And these interwoven capabilities create advantages that sort of compound over time. For example, skills from smartphone chips could help with tablet processors as well. So with all of this information in place, the thing is that the next phase will be very crucial here. The big fund is moving towards more conservative professional management after its corruption scandals. But China faces a very delicate balance between political imperatives and commercial realities. China's companies indicate openness to international collaboration, while the government is pushing for complete self-reliance. Now, the goals are usually conflicting in nature, and what this story reveals is how semiconductors have become the ultimate test of national technological capability. The industry is such that it demands cutting-edge science, massive capital, flawless execution, and historically global cooperation. China is basically attempting something unprecedented, which is rebuilding an entire ecosystem from scratch while locked out of key technologies. They're definitely making progress, but they are also discovering why this industry has remained concentrated among so few players for so long. Now, the implications also stretch far beyond chips, by the way. If China succeeds, it will have proven that technological decoupling is possible even in humanity's most complicated industry. And if they fall short here, it might actually end up reinforcing how much advanced civilization still depends on global collaboration. But either way, their journey is completely changing how we all think about technology, trade, and the future of innovation in the first place. That brings me to the end of the first story. On that note, let's move on and talk about the second one. See, over the last few weeks, you might have seen some very worrying graphs doing rounds online suggesting that India's foreign direct investment or FDI is collapsing. Now, these charts paint a very grim picture, and while they might be exaggerating the situation slightly, they are not completely wrong either. The truth is, India is getting less foreign investment than what we would ideally want, and that problem is what we cannot afford to ignore. Let's first understand why this matters before getting into the details. See, when someone from outside India puts money into our country, not just in the stock market by the way, but actually in building businesses here, that is what we call foreign direct investment. Now you can think of it as somebody setting up a factory, an R&D center, even a call center for that matter, or a big warehouse in our country. And when that happens, it's not just the money that comes in, it also brings along cutting edge technology, global management practices, higher paying jobs, and linkages to international markets. So in short, it actually acts like a fast forward button for economic development. Now countries that have grown very quickly, say for example China, Vietnam, and even India during certain periods, have all done so with the help of strong FDI inflows. But currently speaking, globally FDI is completely drying up. The World Bank recently released a report raising the alarm here. It shows that the amount of FDI that is coming into developing countries, including places like India, has dropped sharply over the last decade or so. Back in 2008, a typical developing economy would receive FDI worth nearly 5% of its GDP, but today that is down to just about 2%. That, mind you, is more than a 50% drop, and that has real consequences. According to the World Bank's data, for every 10% increase in FDI that a country receives, its GDP grows by about 0.3% over the next 3 years. And while I know this may sound like a very small number at first, the thing is that over time and also across multiple sectors, that starts adding up to significant process. So if funding dries up, growth also slows down. And that is exactly what many emerging economies are seeing today. Anyway, with that context in place, let's now take a look at where India stands here. See, over the past decade, India has actually done reasonably well on this part. Between 2012 and 2023, we accounted for 6% of the total FDI that came into developing countries, which placed us third after China and Brazil. Now, of course, that is a decent share, and it shows that the global investors are interested in India. But the worry is that we still need a lot more. Countries like South Korea and Singapore have reached far higher levels of development by attracting much larger volumes of FDI over time. So if you want to follow a similar path, we just cannot afford to see our numbers slide downwards. Now, there are two reasons why this movement is especially crucial for India. The first one is that China, which usually soaks up about a third of all foreign investment that is going into developing economies, has seen a dramatic fall in 2023. To give you a sense, its share dropped from 33% to just 10%. Now, that is a huge vacuum, and somebody obviously has to fill it. Countries like Vietnam and Mexico have already taken advantage by positioning themselves as neutral connector economies. Now, this basically means that they don't pick sides in big global rivalries, and so they become attractive hubs for investment from all sorts of directions. And if you talk about India, if we actually end up playing our cards right over here, we could step into this role as well. Anyway, the second thing is that the kind of investment that is growing globally is now very quickly changing. See, earlier, most foreign investment actually went into the space of manufacturing, but today that's no longer true. Today, nearly 2/3 of all FDI in developing countries actually goes into services. That includes areas like business, consulting, finance, and IT, which is sectors that India has already a strong foundation in. Now, to give you a quick understanding, back in the early 2000s, services made up only 45% of FDI, but now they completely dominate the entire landscape. But that said, the thing is that this shift is actually a bit of a double-edged sword. See, on one hand, it is great for us because we are already attracting FDI into our IT and business services sector through global capability centers, which hire thousands of Indian professionals. But on the other hand, manufacturing FDI, which creates far more jobs across skill levels, is becoming less common, and India has always struggled to attract it. Now, that is a concern because services-led growth can only go so far in employing the millions of Indians that are entering the workforce every single year. So then the question is, what can India really do right now? See, the World Bank report does not just analyze the problem. It also very interestingly provides some very clear insights into what drives FDI in the first place. Now, the first thing is size and growth. Bigger, faster growing economies attract more investment. Now, on this front, India is in a very strong position. We are one of the fastest growing major economies in the entire world. The second factor is productivity. See, countries that are more efficient, which is where workers and businesses can do more with less in some sense, tend to receive more amount of FDI. To give you a quick sense, for every 1% increase in labor productivity, FDI goes up by about 0.7%. Now, unfortunately, this is where India struggles. Our economy has grown very quickly, but our productivity has not kept up pace with it. And that basically creates a very big vicious cycle. Low productivity leads to less FDI, which means fewer opportunities to learn from global best practices, which in turn keeps productivity low again. Anyway, moving on, the third factor is policy certainty and legal protection. See, countries which sign bilateral investment treaties or BITs see 40% more investments between them. These treaties usually offer legal guarantees that protect investors from unfair treatment. But the thing is, India has actually been walking away from such treaties ever since 2016 because of some past cases where foreign investors sued the Indian government. Now, of course, while those concerns are definitely valid, the global data actually suggests that this retreat could actually be costing us very crucial capital. Anyway, another big driver here is trade openness. Countries that are more connected to the global trading system usually tend to receive more FDI. A 1% rise in trade to GDP ratio leads to a 0.6% increase in FDI. And that makes sense. Global companies want to invest where they can easily export and also import. But India's integration into global value chains is still very weak, especially compared to countries like Vietnam, Thailand, or Malaysia. And strengthening these very linkages here is one definite way forward. Anyway, moving on, the truth is that while attracting FDI is definitely one part of the puzzle, another equally important part is how much benefit we get from the investment that we actually receive. Now, interestingly, the report shows that while the average 10% increase in FDI boosts GDP by 0.3%, some countries see as much as 0.8%, which is almost 3 times more. So the question is, what really makes the difference over here? Now, there are two major factors that come up over here. The first one is education. Countries that gain the most amount from FDI usually tend to have higher education levels. Typically, they have 10% more people completing secondary education compared to low benefit countries. And that makes sense because if a foreign company brings in advanced machinery or global systems, it obviously needs skilled workforce that can actually end up using them. Now, in India, nearly half the people who go through formal education are considered unemployable. And that seriously limits our ability to benefit from all the FDI that we receive and we may receive in the future. The second factor here is informality. See, countries with large informal sectors, which is where workers and businesses operate without formal contracts, registrations, or even compliance, tend to usually miss out on benefits of FDI. They cannot really plug into global supply chains, which multinational companies usually operate. Now, in India, this is a massive problem. About 90% of our workforce is in the informal sector, and that is a huge drag, mind you. For example, a company like Apple might want to source from Indian suppliers, but many small businesses here cannot even qualify for it because they lack GST registrations, certifications, and also audited financials. And to understand why this even matters in the first place, let's think about what happened when Suzuki set up Maruti in India. See, they did not just build a regular factory, mind you. They helped create an entire ecosystem of more than 380 component suppliers. That ecosystem completely transformed Gurgaon from agricultural land into a major auto manufacturing hub. That is basically the true power of FDI. But of course, that only happens when the local economy is ready to receive it on the other side. They should have capable vendors, skilled workers, and also a policy environment that inspires trust overall. And the thing is, even if we get all of this right, there are still broader forces we will have to deal with. The first one is geopolitics. See, when countries are locked in diplomatic tensions, they usually tend to invest less in each other. The World Bank found that diplomatic disagreements, which are measured through voting patterns in the United Nations, reduce FDI by 12.5%. And that is already playing out in the way the US is slowly decoupling from China. Now, interestingly, this geopolitical friction can also sometimes help some countries like India, which try to stay balanced and neutral. And that's also what makes connected economies attractive to every investor. But again, this requires policy stability, and unfortunately, India's record on this front has not always been the best. So with all of this said and done, if we do want long-term investment, we need to offer long-term predictability. The second challenge is economic volatility. See, global FDI takes a hit during recessions, especially in emerging markets. In fact, during downturns, FDI into developing economies drops by around 15%, and it takes about a year longer to recover than it does in developed countries. And that means that countries like India need to be especially careful about macroeconomic stability, which is maintaining strong fiscal discipline, low inflation, and sound external balances. In the end, the World Bank's report leaves us with a very simple but a very urgent message. The world is entering a period of low FDI. But the thing is, that also means that the competition for foreign capital will heavily intensify, and the countries that prepare themselves the best, which is by reforming their domestic structures, opening up trade, upgrading education, and also offering stability, will walk away with the lion's share. Now, India, like I said, is in a very unique position here. We are large, fast-growing, and geopolitically balanced. But unless and until we address our biggest weaknesses, which is low productivity, informality, and education gaps, we really may lose this opportunity. So what we do over the next few years could very well define not just how much investment we attract, but how much of that investment actually turns into lasting prosperity for our country. And that brings me to the end of the two stories of the day. On that note, let's move on to the final section and talk about the quick news headlines. First, India's merchandise trade deficit declined to 21.88 billion US dollars in May 2025, which is a significant improvement from 26.42 billion dollars in April. The fall was primarily driven by a sharp drop in crude oil imports, which fell to 14.7 billion dollars from 20.72 billion dollars in the previous month, and gold imports, which declined to 2.5 billion dollars from 3.1 billion dollars. Second, Zee Entertainment Enterprises Limited has approved a 2,237 crore rupee fundraise through the issue of 169.5 million fully convertible warrants on a preferential basis. This move is expected to increase the promoter shareholding from 3.99% to 18.39%. Third and the final one for the day, e-commerce platform Meesho is set to incur a tax outgo of 2,400 crore rupees as it's shifting its holding entity from Delaware, US to India following approval from the National Company Law Tribunal or NCLT. The move, which is positioned ahead of its planned IPO, makes it one of the costliest re-domicile exercises among Indian startups, second only to PhonePe. That's all the news and stories I have for you today. I hope you enjoyed this episode. I'll see you tomorrow. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.